Okay, so Buffett bought stock in a gold company, and that got everybody freaked out because they were already worried about the dollar. So a lot of people think that gold is a hedge against a dying dollar that's losing value, and they thought, hey, if Buffett's getting into gold, then that's a huge signal. Well, in the last video, we went over the proper way to analyze gold, and we talked about how what really matters for gold prices is how much of a return you're getting elsewhere. So how much of a return you're getting in stocks, bonds, and other assets. If that return is low, then people are going into gold. So it's not as big of a direct link to the dollar, but clearly there's still something going on with the dollar, right? And that's what we're going to talk about in today's video. We're going to break down the exact signal that you'll need to look for to know that the dollar is really going to collapse. And before we get into it, if you have not checked out our free training on how to trade these types of markets, then definitely do that now. There's a link in this video and down below in the description and comments. Teaches you the exact strategy that myself and all our Fallible members have been using. We're up over 50% this year. Working out really well regardless of where the dollar is going. So check that out if you haven't already. Now, to understand the right way to analyze the dollar, we got to go to the master. I'm talking about the global macro legend, George Soros. And I know how some people feel about Soros, but actually it seems like this generation's new George Soros is Bill Gates, especially based off your guys' comments. So maybe Soros is very happy to not be the guy that everyone hates for once. But hate him or love him, he is a legendary speculator worth billions of dollars. He's very good at it, and he's written a lot about how he does it. So we're going to go over George Soros's currency framework to understand what's happening with the dollar. We can start with a quote. At any moment of time, there are myriads of feedback loops at work, some of which are positive, others negative. They interact with each other, producing the irregular price patterns that prevail most of the time. But on the rare occasions that bubbles develop to their full potential, they tend to overshadow all other influences. So markets, like much of nature, are composed of infinite feedback loops. And understanding these feedback loops gave Soros a big edge back in his prime. And they're a key part of his theory on reflexivity, which is also a key part of analyzing currencies like the dollar. And reflexivity, long story short, is basically a feedback loop. Best way to understand it is with an example, so we could use Tesla as an example. A reflexivity feedback loop can explain why its price keeps going higher and higher. So the first part to kick off the feedback loop is someone looks at Tesla and says, hey, this is a great company, I want to buy in. So they take their money and they buy shares. And what happens to the price of those shares because they start buying? They go up a little bit, right? Supply and demand. So then what happens is that some other investors see this first group of investors buying and the price going up, and they think, hey, all of a sudden Tesla is popping up on their price scans and they're thinking this might be a good stock. The price is going up. So they buy in too. What happens when they buy in? The price goes up even more. So the first investors start thinking, hey, I was clearly right when I bought the first time, the price has only gone up, let me buy more. So they buy more, price goes up even more. Then you have the third group of investors who are like, I never wanted to get into Tesla. It didn't look like a good company, but the price keeps going up, so maybe it is a good company, and they buy. And you can see how this keeps going, and it's a self-reinforcing loop. Because as you buy and the price gets better, it looks like you're right, so you buy more. And you make more money because people keep buying. And it's that feedback loop that keeps pushing Tesla's price higher and higher. And the same thing can happen on the way down, right? All of a sudden, one person is like, you know what, Tesla is not a good value for me anymore, I'm gonna sell. If they're selling, well, then the price is gonna drop a bit, right? So then the next group of investors is like, hey, I love Tesla, but now the price is going down, it must not be the same type of investment, so they sell. And then so on and so forth, and you get the cascade of the price lower. And that's pretty much how bubbles form and bust in markets and across everything. It's that reflexivity loop. So you can keep that in mind when we're talking about currencies, because currencies are the same thing. It's supply and demand for an asset. But the asset, instead of a stock, it's a dollar. So to understand what's happening with the dollar, we got to look at the primary feedback loops and that reflexivity at work in the dollar. So we're going to take a look at Soros's currency equation, and we'll see why the dollar is at a short-term high. And there will be some reversion to the mean, meaning it's going to go lower. But here's some things to understand. But let's go over the basics to understand how to analyze currencies. So like all markets, exchange rates, which are between currencies, are driven by supply and demand. And currency supply and demand can be separated into two broad categories, fundamental and speculative. So the fundamentals, those are things like the trade and balance sheet of the currency issuer. So of the country, so like the US, what's our trade balance? And then of course, what's our fiscal and monetary policies? Are we printing like crazy? Is Powell at the helm with his printer? Oh, he is? Okay, yeah, not great for the currency. And then of course, budget deficits, we're spending like crazy, and our control of the money supply. All things that affect the dollar. Those are the fundamentals. Then we can look at the speculative demand. demand. And that's centered around the expectations of the relative and future value of the dollar. So think about exchange rate trends. How many yen can we buy with $1? Interest rate differentials. Are interest rates better here or in Japan? And relative market opportunities. Because if you want to invest in the US, then you need dollars to do that. So guess what? You have to buy dollars. To simplify it even further, currency supply and demand is comprised of three things: trade, non-speculative capital transactions, and speculative capital flows. And I know this is getting into the weeds here, but yeah, this is for the macro nerds. And this article and video are way simpler than trying to read Soros's Alchemy of Finance, because that thing is a mess. Lots of good stuff, but it's so confusing. But yeah, this is some real macro stuff. So trade affects exchange rates because of the balance of trade. So what's the balance of trade? Well, countries sell goods in their home currency, right? So what's a US thing? Hot pockets. You can only buy hot pockets in dollars. So for other countries to try and buy those hot pockets, they gotta exchange their Japanese yen or whatever for our dollars. And then vice versa if we want to buy something from Japan. So a trade surplus would be, hey, everyone wants our hot pockets and we got a bunch of money flowing into our country and people converting into dollars. That would be an appreciating force on the currency. It would push the dollar higher. But if everyone was focused on buying a product out of Japan, which I can't think of one off the top of my head other than my favorite export, anime, well then people would be getting rid of dollars and converting into yen, and that wouldn't be good for the dollar. So that's how balance of trade affects the currency. Then you got speculative capital flows, right? And that's just speculation. It's the buying and selling of currencies like the dollar or whatever, people trading with no underlying asset. So the speculative capital moves in search of the highest total return. Money wants to move to where it's treated the best, right? Where it's going to get the best return. So that total return is made up of exchange rate differentials, interest rate differentials, and local currency capital appreciation. Lots of words. That's why this stuff is heady. So of those three, the most important are those exchange rates, because they fluctuate way more than interest rates or relative market returns. So it doesn't take much of an exchange rate decline or increase to completely overshadow everything else. So in the short term, over a few months to a few years, those exchange rates are driven by speculative flows. But in the long term, economic fundamentals, which is trade and non-speculative capital transactions, those are the ones that dominate what's happening with the exchange rates. So it's the dynamic tension between these two that determine the trend of different currencies. So if we look back to currency supply and demand, these top two, trade and the capital transactions, they're long term, and this bottom one, number 3, is short term, a few months to a few years. And trying to fit these things together is not easy, and that's why we have Alex and Macrohouse to do it for us. But it's nice to understand at least what's kind of going on. So Soros broke this down into a really easy, friendly equation in the Alchemy of Finance, which it is not at all. At least for me, but maybe I'm stupid. So here's the different variables that go into the equation. E, which is the nominal exchange rate, which is the number of foreign currency, like how much yen for buying $1. So if E is going up, then that's strengthening the dollar. I, which is the nominal interest rate. V, domestic versus foreign price level. So how fast are domestic prices rising versus foreign prices? Then we got V, level of economic activity, N, non-speculative capital flow, T is trade balance, and B is government budget. These are basically all the inputs that go into the equation of what affects the dollar and other currencies. So the thing to understand is that the importance of each one of these individual drivers, it shifts over time. So each regime has a different factor that matters more. And that's why Forex markets are really tough to forecast, because most of the people are keying off the thing that worked during the last cycle while unaware of what's driving the current one. Are you guys still with me, or did you fall asleep? Well, I'm gonna keep going. So we've been in a big dollar bull market that kicked off in 2011, and that was driven by this equation, which I'm not even gonna try to break down. But basically what it's saying is that US growth was stronger on a relative basis compared to the rest of the world. And this led to good interest rates in the US, which drove exchange rate appreciation, the dollar becoming more valuable. And that brought in speculative flows, because better interest rates, dollar being more valuable, money's gonna go there. And that money goes into our assets like stocks and bonds. And this ended up driving our relative market outperformance. Like our stock market has been crushing it. So as a result, the US dollar really benefited, because the total return equation, people were getting a great return on the dollar. And that's the most important factor in driving speculative flows. And remember, these speculative flows are what determines the trend of the dollar over the short to medium term. So here's here's an interesting chart. It shows the US relative growth to the dollar. You can see how related they are. So you can see when the US growth, this blue line, was really strong, then the dollar was rising. But that growth compared to the rest of the world peaked in 84, 1 year before the dollar turned around, and the dollar is this yellow line. So you can see the US relative growth is a leading indicator of the dollar. Here, once again, growth peaked in 98 before the dollar turned over. And now in the present time, US growth peaked in 2015. And now we've seen the top in the dollar. So things are changing. All the factors that we just mentioned that created that bull market from 2011 are no longer supporting the dollar. So that relative growth, yield spreads, exchange rates, they're all working against the dollar now. And also we've got a terrible trade balance sheet and a widening budget deficit. You can see right here, trade balance crashing, deficit exploding, can't stop printing. So now out of all the factors, the dollar only has its relative market performance working in its favor because our markets are still crushing it. To the moon, right? Look at this, print our way to the moon. So reflexive processes tend to follow a certain pattern. In the early stages, the trend has to be self-reinforcing, otherwise the process aborts. But as that trend keeps extending, it becomes increasingly vulnerable because the fundamentals, such as trade and interest payments, move against it. The fundamentals deteriorate, the trend can't keep going. So that trend, instead of being backed by those strong fundamentals, it's basically held up by the previous belief. There's a bias, like the dollar kept going up, so it should keep going up. But eventually a turning point is reached and people wake up, and then you see the loop in the other direction. So if our market performance is the only thing that's holding up the US dollar right now, well, we know it is historically stretched. You can look at this chart right here. And this is another concept from Soros, benign versus vicious circles. So during a benign circle, that's when the currency will appreciate, and during a vicious one is when it depreciates. So benign circles in the US are characterized by low inflation, an easy Fed, a strong dollar, and US outperformance. A vicious circle is marked by above trend inflation, a weak dollar, and US underperformance. So those are the circles or cycles that it keeps going through. Right now, we're in a benign one because the dollar was strong, right, from 2011. But you can see our equity market right here is way above the trend that was set before. So capital concentration in the US, which is important, right, because people want to put their money where it's going to be treated best. If they want to put it in the US, then they're buying dollars, and that's pushing the dollar higher. Well, that concentration is likely near its zenith, its peak. The valuation premium placed on US financial assets is over 1.5 standard deviations above its long-term average. You can see right here, it was at this point near the dot-com bubble, the great financial crisis, Trump tax cut, and now COVID, CCPV. And it no longer has the supportive tailwinds of positive growth, yield, or exchange rate differentials. Like we said, everything is turning against the dollar. So really, the one thing that's preventing the dollar from completely tipping over and collapsing is relative US asset outperformance. And where is all that outperformance coming from? Well, it's coming from the bullish trend in tech, which we're all very familiar with. Stocks such as Tesla, which we just used as an example. So if we know that the market is being held up by tech and the dollar is being held up by the market, then what's the signal that we should be looking for? Well, we should be looking for when US tech begins to bend, when the trend starts to turn around, because then we can look at the dollar, which was being supported by the market, which is being supported by tech. When that support gives way, then yeah, the dollar is going to fall. So we are in the final bullish phase of the US dollar. It's ready to turn around now. And when it turns around, it's going to go into one of these vicious circles where it's going to depreciate a lot. And if this kind of reminds you of the boom bust cycle of our economy, well, yeah, everything is cycles. The tricky part is trying to figure out how they all fit together. So the new regime, when the dollar is falling, will likely be led by commodities, emerging markets, cyclicals, and value. Now, an important thing to understand is that this is just a standard cyclical turn in the dollar. It's not a huge secular thing, and in no way does it reflect the USD's status as the world's reserve currency. So no, this isn't the death of the dollar. This is a normal process. You can see it's happened so many times over the last few decades, right? Dollar value goes up and it goes down and goes up again. So right now, the dollar is near a major support and we should be seeing a bounce, which it looks like we are seeing that bounce. But if the bounce doesn't last and there's a failure at this point right here, well, then that would be an important signal and it would tell us that the trend down for the dollar is starting for real. But for right now, it's still in this long-term 5-year consolidation. The break below this level would mark the start of a new regime. And remember, this doesn't mean it's the end of the dollar and the end of the US right now. I know when we do our Dalio videos, he loves to talk about that. He's real excited for the dollar being over or something, I don't know. He just seems very biased and in favor of China to me. But anyway, in the next video, we'll explain more about why this isn't the death of the dollar, as everyone thinks it is. If you want to see that, make sure you subscribe. And if you haven't already, take this training, because all this dollar stuff is more long-term, but most of of us are invested in these equity markets. So we need a strategy that works right now and in the future, of course, but you need to be more tactical, and this will help you do that. Free training will teach you exactly how to do it. There's a link in this video and down below in the description and comments. Take the training, subscribe, and I will see you in the next video. Stay fallible out there. Bye.